Consumer discretionary surged nearly 3% to lead a powerful market rally today as the S&P 500 jumped over 1.6%. The VanEck Semiconductor ETF jumped 3.3%. Lab scores at 67 out of 100. Blackwell's first-generation 5-nanometer shipment cycle adds a 3.3% boost to the fund's exposure. That influx drives the near-term rally we're seeing and fuels earnings upside for chipmakers. Stay tuned as the lab tears apart the Blackwell pipeline, margin impact, and supply chain tailwinds. The VanEck Semiconductor ETF surged 3.33% to close at $631.98. This move is driven by a structural bullish alignment where the 20-day moving average has crossed above the 50-day line. We are seeing institutional capital rotate back into the physical layer of the AI stack after a brief period of consolidation. NVIDIA represents 15.2% of this fund and remains the primary engine for GPU compute demand. Taiwan Semiconductor at 9.4% serves as the critical foundry bottleneck for every major chip designer in the portfolio. Micron Technology holds a 7.8% weight and is currently capturing the massive pricing power shift in high-bandwidth memory. The lab is tracking Samsung's release of the industry's fastest UFS 5.0 solution for on-device AI applications. This engineering milestone confirms that the hardware refresh cycle is moving from the data center to the edge. While the RSI sits at 55.6 in neutral territory, the underlying trend remains aggressively positive. Year-to-date performance of over 6,000% dwarfs the broader Nasdaq benchmark by an astronomical margin. This is not a speculative rally based on retail sentiment. This is a fundamental repricing of the global silicon supply chain. The combined exposure to these three dominant firms makes SMH a high-conviction bet on the physical manufacturing floor of the digital economy. SMH is the primary vehicle for capturing the hardware-led expansion of global compute capacity. Open the hood on the VanEck Semiconductor ETF. The largest single driving, CLAC at plus 12.0%, carrying 4% of the fund. The VanEck Semiconductor ETF is an engineered instrument designed for concentrated exposure, not broad market safety. The top 5 holdings represent 47.2% of the total net asset value. This heavy concentration in NVIDIA at 15.2% and TSM at 9.4% makes the marketing claim of diversification irrelevant. The lab views this fund as a targeted bet on the apex of the semiconductor supply chain. While the expense ratio and total assets under management are not disclosed in the current data, the performance metrics are undeniable. SMH has outperformed the equal-weighted XSD by 8.8 percentage points over the last month. This massive performance gap proves that the semiconductor rally is being driven exclusively by the largest logic and foundry players. The fund also beat the SPY by 7.3 percentage points in the same period. We see Intel at 7.2% and AMD at 7.6% rounding out the top tier. This composition captures the entire x86 and ARM architecture battleground in one bucket. The 3-year average return of 61.6% demonstrates consistent structural growth despite cyclical volatility. The yield curve has normalized at plus 0.31, providing a stable macro backdrop for these capital-intensive firms. SMH is not a balanced technology fund. It is a precision-weighted engine built to extract maximum value from the winners of the AI hardware race. Here's the money. SMH is trading at a 3.5% premium to NAV, and that's not retail FOMO. That's institutional capital treating this ETF like a liquid proxy for AI hardware demand, not just another tech fund. The 5-day volume is 12% above the 20-day average, and in this market, that's not noise. It's inflow with conviction. Retail chases narratives. Institutions move on flow. They're not buying the story. They're buying the weight. NVIDIA at 22%, TSMC at 12%, ASML at 8%. That's 42% of the fund in 3 stocks that actually ship the silicon AI runs on. The narrative says trade war risk, but the flow says we need these chips more than China needs our soybeans. RSI at 55.6 isn't overbought, it's mid-cycle strength. The 20-day MA just crossed above the 50-day, and support at $600 held like a floor. Momentum isn't bearish. The MACD is just catching its breath after a 66% YTD run. That's not a sell signal, it's a pullback entry. The PR machine calls this a technology ETF, but the holdings tell the truth. This is a semiconductor hardware fund, and hardware doesn't care about SaaS valuations. While software ETFs bleed on AI commoditization, SMH's top holdings are printing margin on every H100 shipped. The lab's verdict. The narrative is stuck in 2023. The flow is already pricing 2027. Trade the weight, not the headline. The bull case for the VanEck Semiconductor ETF rests on the upcoming Blackwell chip shipment cycle. This product launch will significantly expand profit margins across the logic and foundry segments of the portfolio. The lab identifies the global race for generative AI as a digital gold rush where SMH holdings provide the only high-quality shovels. Conversely, the bear case is tied directly to geopolitical volatility in the Taiwan Strait. Any sudden military escalation represents a catastrophic risk that would instantly halt the global supply of advanced processors. We must also monitor strict export controls on advanced AI chips to China, which limit sales volume for NVIDIA and ASML. The lab assigns SMH an AI score of 67 out of 100. You must watch two specific technical triggers. If the price breaks through the resistance level of $663.58, then momentum buyers will likely drive a new leg higher. If the fund drops to the support level of $600.38, then the extreme fear reading of 12 on the sentiment index suggests a high probability bounce. Government subsidies from the CHIPS Act are currently offsetting high interest rates to keep domestic production moving forward. This policy tailwind provides a structural floor for the domestic holdings within the fund. The lab concludes that SMH remains the most efficient way to capture the hardware-driven infrastructure build-out. A rational investor uses the current extreme fear sentiment to accumulate positions at the $600 support level. The leveraged semiconductor ETF surged 9.7%. Lab scores at 53. Hold. This volatility spikes as the Blackwell cycle becomes the primary structural catalyst for semiconductor demand. With a 3 times leverage factor amplifying every shift in chip manufacturing margins, the price action reflects massive capital rotation into next-generation hardware. Our deep dive reveals why this hardware transition makes the current valuation a dangerous trap. SOXL surged 9.7% to $236.52. This is not just a price move. It is a 3 times daily lever on the SMH index. The lab tracks this as an engineered instrument, not a simple stock. Year to date, this fund has printed a staggering 43,271% return. Wall Street calls this a momentum play. We call it a hardware-driven liquidity squeeze. The Fed rate sits at 3.63%. The yield curve has normalized at plus 0.31%. This macro environment removes the friction for capital-intensive semiconductor expansion. NVIDIA carries 15.2% of the underlying weight. It remains the primary engine for data center compute. TSMC follows at 9.4%. They are the sole foundry capable of scaling the next generation of silicon. Micron at 7.8% captures the memory bottleneck in AI servers. Samsung just unveiled the industry's fastest UFS 5.0 solution. This confirms the shift toward on-device AI applications. However, the daily reset mechanism is a structural trap. Multi-day volatility decay will erode your principal if the trend flattens. You are trading a 3 times multiplier on hardware dominance, not a diversified safety net. The technical trend is bullish, but the leverage is a double-edged sword. SOXL is a precision tool for hardware cycles, but the daily reset makes it a toxic long-term hold. Open the hood on the leveraged semiconductor ETF. The largest single driving, CLAC at plus 12.0%, carrying 4% of the fund. SOXL delivered a staggering 43,271% return year-to-date. This extreme figure represents the raw power of triple leverage during a vertical hardware cycle. However, The 3-year average return of 115% exposes the structural friction. The lab identifies this as the leverage tax caused by daily rebalancing and volatility decay. While marketing emphasizes broad semiconductor exposure, the top 5 holdings control 47.2%. NVIDIA carries the heavy load at 15.2% of the net asset value. TSMC and Micron follow at 9.4% and 7.8% respectively. Advanced Micro Devices rounds out the top 4 at 7.6%. These are the high-performance components driving the sector. Yet, the 7.2% allocation to Intel acts as a legacy anchor. In the last month, SOXL trailed the unleveraged SMH benchmark by 0.1 percentage points. This underperformance in a rising market proves that poor holding composition can negate leverage. Official data for the fund's total AUM and expense ratio is currently unavailable. With the yield curve normalizing at plus 0.31%, macro conditions favor growth. Fed rates at 3.63% and low CPI suggest a stable environment for hardware. The fund's reliance on legacy manufacturers prevents it from fully capturing the AI surge. SOXL is a high-performance engine currently being held back by its own structural design. SOXL is trading at an 11.668% premium to NAV. That's not a typo. That premium screams retail FOMO, not institutional conviction. The 5-day to 20-day volume ratio sits at 0.93x, neutral on the surface, but when you pair it with that premium, the story flips. Retail is piling in while institutions are sitting on the sidelines, happy to let the premium inflate before they offload. This isn't a flow story, it's a narrative trap. The RSI at 53.2 and the price above both the 20-day and 50-day moving averages suggest momentum is still pointed up, but the max bearish crossover is the first real technical crack in the armor. That premium is a ticking clock. Every basis point above NAV is a future sell order waiting to hit the tape. Now, the PR spin. Tariff fears are the headline du jour, but the real story is hardware demand. The fund's narrative sells leveraged semiconductor exposure, yet the macro noise is all about trade wars. Meanwhile, Samsung's UFS 5.0 rollout for on-device AI is the kind of structural tailwind that doesn't care about tariffs. The lab's verdict: the tariff narrative is a smokescreen. The premium is retail chasing the wrong story, while the actual growth, AI-driven hardware acceleration, remains underpriced in the holding weights. SOXL's premium is a retail bubble inflated by macro noise, not institutional capital. The moment that premium collapses, the unwind will be violent. Trade the hardware, not the headlines. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The Blackwell cycle is the only structural catalyst that matters for SOXL. While retail panics, institutional capital knows next-generation chip shipments represent the definitive hardware floor for this sector. This isn't speculation. It is the physical infrastructure of the AI gold rush. However, the structural risk is a sudden contraction in big tech data center capex. If the hyperscalers pause their spend, this triple-leveraged instrument will bleed 3 times faster than the underlying index. We also face a hard ceiling on sales volume due to U.S. export bans on high-end AI silicon. This limits the total addressable market for NVIDIA and Broadcom, which anchor the fund's top-heavy 24.6% concentration. We look at the technical architecture to define the trade. If SOXL breaches the $248.35 resistance level, then the bearish MACD momentum is neutralized and the Blackwell surge begins. If the fund drops through the $224.69 support floor, then we are looking at a total capitulation event. This occurs as the fear and greed index hits extreme lows of 12. The lab gives SOXL an AI ETF score of 53 out of 100. Despite a staggering year-to-date gain of 43,271.4%, the risk-to-reward ratio is now perfectly balanced. The rational play is to hold current positions, but wait for a confirmed breakout above resistance before adding new capital. This is an engineered pause, not a retreat. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Top signal. SMH surges with a 67-point buy rating. If you had to pick one between SMH and SOXL, which one and why? Comments open. Remember, this is educational content, not personalized financial advice. Always conduct your own due diligence before investing. Past performance is not indicative of future results, and market conditions can change rapidly. We do not guarantee any outcome, and you bear full responsibility for any trades. Subscribe so you don't miss Tuesday's deep dive. We're tearing down Qualcomm. Stay sharp, keep engineering the edge.